Perfect. Okay, so today we're going to talk about, actually, it's kind of a hodgepodge of topics, but the focus is some of the signs of froth that we're seeing in the markets on both the commodity side and the equity side. And then we're also going to talk a little bit about how you may go about portfolio hedging. So for those of you that are investors, whether it's intermediate term or long term, might not be a horrible idea to have some sort of hedge on your portfolio just in case something goes sour. So we're going to talk about that sort of thing as well. We're also going to talk a little bit about what happened with the options markets in GameStop, as well as what we've seen, and even on the commodity side of things in silver and copper, and a lot of that type of fun stuff. So this is my contact information. If you have any questions or anything, my name is Carley Garner. You can reach me on social media, Facebook, Twitter, Instagram, YouTube. Just search either DeCarley Trading or Carley Garner. We are a boutique futures and options brokerage service. We're located in Las Vegas, Nevada. We're a branch of the Zahner Group, who's headquartered out of Chicago, but it's a little too cold in Chicago for my taste. This is my dog, Frankie. The reason I have this up is, well, I often get requests for dog pictures. Don't ask me why. I post a lot of dog pictures on Instagram, and she has a fan club. If you're interested in learning more about trading options and futures, I've written several books. If you go to Amazon.com, you're going to find them for the lowest price. That said, there's several books listed on the site. Ignore all of them except for these three. These three are the newest. These are the latest and hopefully greatest. At least that was our goal. The others are from previous publishers. Not only are they outdated, but they're also out of print, which means you're buying them on the secondhand market, and they're really, for some reason, they're oddly expensive. So don't do that. Focus on these three books. If you want some more information on the books themselves, you can go to tradingcommodityoptions.com. And if you are interested in mobile phone apps, I know a lot of people don't do email so much anymore. If you're interested in an app, we do have an app, and it's an informational app. It's not necessarily to place trades, although our clients do have access to an app to place trades. But this one is for just information, commodity news feeds, newsletters. We write in-house newsletters and put out trade alerts for our brokerage clients. You can sign up for a trial of those within the app. You can also sign up for a trial at decarleytrading.com if you're interested. And one more thing before we get started, there is a substantial risk of loss in trading futures and options. Trading is absolutely not suitable for everybody. It's an emotional roller coaster. Sometimes it's fun, sometimes it's torture. And I would say it's probably not suitable for most people, to be honest. So the markets have been obviously relatively exciting lately. There are some dramatic rallies going on in both the commodity space as well as the stock market space. We are of the opinion that maybe things have gone a little too far, a little too fast. I mean, there's lots of reasons for this, but the markets are mostly pricing in a complete recovery from the coronavirus fiasco. And I think that obviously eventually we will get there, but I just think we're not quite there. And I think the market's discounting a lot of things that could go wrong. In short, the markets are pricing in perfection, and there's probably a good chance we're not going to get perfection. Another thing that we've been noticing is severe signs of froth and complacency on social media, in chat forums, even on business TV, all those sorts of things. One thing that I've learned over the years is trading is not a walk in the park. It's not easy money. It's not get rich quick money. I mean, it can be sometimes, I guess, but in the long run, it's not. It's really hard to make money in the markets. That said, we've kind of got this perfect storm. And by the way, I just want to warn you, a lot of these slides are very wordy. They're not for you. Don't feel like you have to read them. They're really just kind of for my notes. If you want a copy of the slides, by the way, just email us and we'll send you a copy. Anyway, at the end of the presentation, I'll show my email address again, but it's cgarner@decarleytrading.com. So there's all kinds of things that we've noticed. If you look at the COT report, which is a commitment of traders report issued by the CFTC, there's some hefty speculation going on. We've got really large positions, net long positions in markets like copper and crude oil, massively net short positions in treasuries. So traders have gotten really overwhelmed or overzealous, let's say that's a better word, with risk on trades. And that sort of thing can last in the short run, but it's probably not going to last in the long run. One of the most frothy things we've noticed is some crazy stuff popping up on social media. For example, if you watch TikTok videos that have to do with investing, there are some really popular TikTokers that are saying crazy things like, quit your job and buy call options in the stock market with this strategy. And the strategy is, if the stock's going up, buy a call. And when it starts to go down, just get out, just sell it. Now, I've been doing this long enough to know that that is not a strategy, not one that's going to work in the long term, but it has worked. I mean, anybody that's bought call options in the last 5, 6, 7 months has probably managed to make money whether they knew anything about trading or not. It's how the markets have been behaving. We've also noticed that there are a lot of young investors that are prioritizing environmental impacts rather than risk and reward. So for example, I've had a lot of inquiries as to whether or not it's actually a good idea to buy Bitcoin because of the energy that it takes to produce Bitcoin. The energy consumption in itself is bad for the environment. So therefore, they believe that Bitcoin is not somewhere they should put their money. I almost agree with them that Bitcoin's maybe not the best place to put your money. That said, I come to that conclusion for many different things, mostly risk and reward, than environmental issues. But that's my opinion. I mean, all I'm trying to say is, when people are thinking of buying or selling something, but they have absolutely no care about the risk or the price, then something's not quite right in the market. Something is wrong and something is frothy. And it's not just the AMCs or the GameStop stocks. There's a lot of weird things going on in the S&P 500 options on futures. We're noticing that if you look at the busy strike prices, there are almost double the amount of trading on the calls than there are the puts. And there's almost double the quantity, of course, in the calls than the puts. This is the exact opposite of what we saw in March. And we know what happened in March, right? March 2020, the market bottomed out and really hasn't looked back since. So I'm not saying that we're going to get a complete collapse, a repeat of what we saw last year, but I'm saying be cautious and maybe consider hedging your portfolio risk going forward. And one more thing I'd like to point out, that in healthy, normal markets, options are priced to lose. So in most market environments, when you're simply buying options, not selling them, you're already behind the curve, right? In this particular environment that we're in, which consists of easy money and free money, let's beyond more than easy, just free. So free money and a cheap dollar, we're getting a situation where people simply have money to risk in the markets, and they're willing to put it anywhere that they can find. And that's, in the short run, that can obviously move markets. We've seen that. In the long run, it's not something that works forever. Another thing that we've noticed that's extremely concerning is the majority of trading volume in the options pit, or I shouldn't say pits, pits don't exist anymore, but in the options on futures, is really short-term expirations rather than distant expirations. So in other words, we're talking about people that are trading options that expire today, tomorrow, the next day, not next month or the month after. They're trading weeklies, not monthlies or quarterlies, which is fine. I think the weekly options are absolutely fabulous, but what it tells me is this is a very highly speculative market. These people that are participating and driving prices today are not investors, they're traders. And again, it's fine. It's just we need to understand what we're looking at and behave accordingly. A good friend of mine, Linda Rashke, once said The minute you think you've found the key to trading, I promise the markets will change the lock. And I have a feeling that a lot of the green speculators that have managed to make a lot of money in the last several months just by simply being at the right place at the right time and catching those trends, I think they might find out the trading is maybe not as easy as they thought it was. So why does it matter? Well, I mean, in the short run, it really doesn't matter. In the long run, everything matters, right? But what I'm trying to point out is when there's aggressive speculation, particularly in the option space, it can temporarily distort market prices. This is exactly what happened in GameStop and AMC, some of the stock options and stock market securities that we've talked about here over the last couple weeks. Now, to be 100% transparent, I am a futures broker, not a stock broker, so I'm not an expert in individual stocks, but I do follow the options market very closely, options on futures, and so I know how the mechanics work. And what tends to happen is if you get an unreasonably high demand for call options, the futures, the underlying asset price, and in my case, the futures price, but in GameStop, the stock price, it kind of gets sucked up almost like in a vacuum manner. And the reason being, when traders are buying call options, the person on the other side of that trade is usually a market maker. The market maker is selling that call option to them. Anybody that's ever sold options knows that you have unlimited risk. So the buyer of an option has limited risk, the seller has unlimited risk. So the seller of that option, although he's just doing it to provide liquidity to the marketplace, he must hedge his risk or he runs the risk of being just quite simply run over. So if a market maker is selling a bunch of call options to retail traders who are all buying, in the case of GameStop, they were all buying basically at the same time, that market maker then is forced to buy the underlying asset, whether it's the stock or futures, whatever it be, and that forces the price higher. Now, these types of situations can occur regardless of fundamentals. Fundamentals literally have no play in anything that's going on here. So in a nutshell, when you get aggressive call buying, it's a way of, well, let's just put it this way. In short, the market is being dominated by fast money, and this isn't going to always be the case. And again, I'm not talking about specifically GameStop, AMC, those types of stocks. I'm actually talking about the S&P itself and even Nasdaq. On the futures side of things, we are seeing extremely aggressive call buying, which makes me wonder if maybe another thing I've learned in the markets is the markets are very sadistic. They're very mean. They look for a way to cause the greatest amount of pain to the greatest number of people. And the way that I believe will happen going forward is that buying call options will be the pain trade. No longer is buying call options going to be easy money. They're all overpriced. If you want to buy in near the money S&P call that expires in a couple of weeks, you're talking several $1,000s, whereas last year would have been hundreds of dollars, not thousands of dollars. So they're really expensive. So if the music stops and the market just, I'm not saying the market even sells off. If the stock market just, the volatility in the stock market contracts to a more normal level, those call options will lose value quickly, and anyone trying to buy them, hoping for the explosions we've seen in the last several months, are going to be sadly disappointed. So I just wanted to bring up a gamma squeeze. We've heard a lot about that in the last couple of weeks. Before we can talk about what a gamma squeeze is, we need to understand what delta and gamma are. Now, if you're not an option trader, you may or may not be familiar with these terms. If you are, you probably are. The options analytics software have what are called the Greeks, and they're basically equations that tell us how the option is reacting to market price in a nutshell. The delta is the rate of change of an option price relative to the underlying asset. So for example, if you're trading a crude oil call option and the delta is 30 and the futures market moves 1 point or $1, that option moves 30 cents. That's basically telling us how reflective or how reactive that option price is to the underlying futures market. The gamma is kind of the delta of the delta. It's telling us how quickly that delta adjusts to changes in the underlying asset. So if the gamma is 0.02 and the market moves $1, the delta either goes to 0.32 or 0.28, depending on whether the market went up or down. So in a nutshell, the gamma is just telling us how fast the delta is changing, and the delta is telling us how fast the option value is changing. I know that's a lot to digest in a quick slide like that, but the point that you need to understand, you don't have to understand the details, but the point you need to understand is when options are purchased, not because of fundamentals or even any other good reason other than trying to gamma squeeze the market, it can and does have an influence on prices. So one more definition before we get into gamma squeeze. A price squeeze is a rapid price movement in a futures contract or a stock that forces investors to make changes out of panic or necessity. For example, let's just take crude oil of last year. If anyone remembers April, May, crude oil, the market plummeted, right? In the front month, the prices dropped below zero temporarily. Now, that's the fun thing everybody likes to talk about, but the reality is the back months really never got much below 20. The front month was illiquid and only a handful of contracts traded down there, but that's besides the point. The point is, people that were selling crude oil at $20 or below probably were not selling crude oil because they were bearish or because they fundamentally thought that crude oil had no value at that price. They were getting out of crude oil, or they were selling crude oil because they were either out of money or out of margin, or they were just quite simply scared. So they were selling because they had to, not because they wanted to. That's a price squeeze. In that situation, that was a long squeeze. The more common squeeze is a short squeeze, and that's because for the most part, investors are buy and holders. They're harder to squeeze out than active traders who tend to be short the market. That's a whole other story. A gamma squeeze is a type of squeeze that forces option sellers, usually market makers, to aggressively hedge their price exposure. So we kind of talked about this a second ago. A market maker that's selling calls to take the other side of retail traders' orders of buying calls has to hedge himself, and he does that by buying the underlying asset. And it sucks the price up. And again, doesn't matter what the fundamentals are, it doesn't matter what the chart looks like. People, when they start seeing these squeezes, believe that there's technical resistance or the market's overbought. But the reality is those things just simply don't matter. People are getting out because they have to, not because they want to. Or in the case of the market makers, they're buying futures because they have to hedge their price risk, not because they're bullish or they think the market's going up. So all of these signs of froth that we've talked about are quite interesting. They're things that we kind of, it almost feels like they're normal because these types of things have been going on for months now, and they've worked, and they've continually worked, buying call options in the stock market on every dip, or buying into the stock market on every little tiny dip. I mean, the biggest dip we've seen was this recent dip, and that was 3.8%. That's hardly a dip. I mean, most corrections are 10 to 13%, and then occasionally we get something a little more. But a less than 4% correction, and it's not even qualified as a correction, but we'll call it a dip, is minimal. And it's unusual for us to go this long without any type of meaningful correction. Now, it does happen occasionally. And when these sorts of long bullish runs do occur, because people, let's face it, people are in the habit of buying dips. Every little sell-off, they buy the dip. Someday that's going to stop working. I don't know when that day is going to be. Maybe it'll be tomorrow. Maybe it'll be 3 months from now. I wish I knew. I'd be a wealthy person if I knew. But what I do know is the day will come. And so I'm not saying that you should be bearish and sell the stock market. I'm not saying you should do something crazy like that. All I'm saying is just be aware and be cognizant. Don't get caught being too complacent, because the worst thing you could do is assume that the Fed's always going to be there to save us, or the dip buyers are always going to be there to save us. One day they won't be. Also, markets are not video games. That I'm not bad-mouthing anybody that has participated in any of the meme stock plays or anything like that. It's fine. I mean, everybody's trying to make a buck. Speculating is speculating. But with that said, markets are not video games. Eventually, fundamentals will matter. Eventually, reasonable asset prices do matter. So there's a couple things that we're thinking of. First of all, the stock indices themselves are incredibly overbought. I'll show you a couple charts here in a few slides. So there's three things that could happen from here that are a little bit concerning. We could get mean reversion trade, which would mean profit taking or counter speculation. I mean, obviously, there's got to, if there may not be any bears left, to be honest, in some of these risk assets, like for example, copper and crude oil probably squeezed out most of the bears. I know the sentiment readings that we're looking at suggest that there are about 80-ish% of industry insiders that are bullish crude oil and bullish copper. Those are massive extremes. Those numbers should be closer to 50-60% in a healthy market. So the fact that 8 out of 10 industry insiders think copper and crude oil are going up is very concerning for somebody that has an intuition to buck the trend. So eventually there's either the buying's gonna dry up, we're gonna get some short sellers that finally have enough confidence to get in and do something about it, or there will be profit taking that could potentially trigger large correction across risk assets. The alternative is maybe we don't get that. Maybe we simply just trade sideways for a long time. I'll show you a slide in a few minutes that will show you just how far ahead the market might be of itself. Again, just because the market's ahead of itself doesn't mean that it's going to sell off. Maybe to just trade sideways to digest the news. And we've seen this before. Stocks almost always go up over time, but there have been periods of decades where they simply trade sideways, and that's probably because at one point it got ahead of itself, and then we had to digest that before we could continue higher. One really big factor that most people don't pay attention to is the currency markets. The dollar has been in the dumps lately. It's had a hard time getting off the mat. Nevertheless, you should not count out the dollar. The dollar could, in my opinion, probably will find a way out of this hole and will move right back up into the high 90s, maybe even the 105 area. If you look at a long-term chart, there's 3 levels of support immediately underneath the current pricing. And there's a lot of room before we get into any significant resistance on the upside. I believe the dollar's putting in a bit of a trading channel in which high 80s will be the lows and the probably low 100s will be the highs. And if that's the case, the world could look dramatically different in a couple months. So this is a chart of the Nasdaq futures. It's the Nasdaq 100 if you're interested. It's obviously a 20+ year chart, and we can just see how abnormal this environment is. If you're looking at a daily chart, sometimes it's hard to see what's going on. And if you're watching TV and hearing about buyers on the dip, for example, last week when we had a little correction, buy the dip was trending on Twitter, and guess what? That's what everybody did. So everybody's been trained to buy the dip because it's worked. But we should always keep this in mind. The Nasdaq took 10 years to move 7,000 points from roughly the financial crisis lows to a few years ago, we'll say 2018 highs. But it's only taken 10 months to move that same span since the March lows. Again, that doesn't guarantee that things are not right, but I can tell you markets generally do not go up at that type of an angle. It's generally, the rule of thumb is a 45-degree angle. Obviously, it's not that easy. If it were that easy, trading would be a little more, everybody would do it, let's put it that way. But it's clear to see that this has been a really overheated market, and it's hopefully clear to you that maybe it may continue, but there's a chance that it may not. And if it does not, things could get ugly pretty quick. Another thing I like to point out is there's divergence on the weekly, or actually this is the monthly chart, but there's divergence on the weekly and monthly charts for both the Nasdaq and the S&P. And what that means is, as the futures is making new highs, the indicators are not, or the oscillators are not. In this situation, we're looking at the RSI, which is the relative strength index. And we've seen every new high that the index has made, the RSI has made a lower high. Again, there are never any guarantees that these types of things will turn prices around or the trend's going to change, but they're clues to simply let us know that, hey, what we're seeing is not normal and maybe it's not going to last forever. So maybe we should behave accordingly. The S&P is a little more reasonable when it comes to price action, but I still have to probably categorize it as tulip mania, almost, maybe not quite. That's probably a little dramatic, but we've seen since the 2016 election night low, the market has had obviously a pretty volatile uptrend. You can say it's politics or not politics. I'm not going to get into that side of things, but the reality is volatility has been pretty intense since 2016, and it hasn't seemed to subside here in the last couple of months. So we'll see how things go. I do not expect a return to the irrational fear trend line that we've got going on down towards the bottom of the chart. Which would be here. I do not expect that, but I would not be shocked to see a test of this. That would be roughly the 3,000, maybe more realistic, somewhere around 3,100. Even that's a pretty big tumble from where we are and seems almost impossible. But the reality is that would probably be a more comfortable place to be. I think we've really overshot things here. I mean, the economy is obviously on decent footing, considering everything we've been through, but I don't think we're to this level yet. When I look at employment and some of the other things going on, some of the underlying issues, it just makes me wonder. And even though I say that, we should also recognize that the economy and the stock market are two different things. So just because the economy is good or bad doesn't necessarily mean the stock market's going to follow. It has a mind of its own, mostly because of speculation. Also, the market's forward looking, all of those sorts of things. This is something that we've had our eye on that we feel like it's worth pointing out. So again, I know I mentioned earlier, most people kind of ignore the currency markets, especially when stocks are flying high like they are. But we should remember that a weaker dollar tends to enable more robust stock rallies. So when the dollar is lower, the S&P tends to go up faster and farther than it otherwise would. Now it can still rally with a higher dollar, but it tends to be a little tamer. So for example, if we look here, the dollar is, by the way, the dollar's in green and the S&P is in blue. So the dollar and the S&P went up together in this period, and that's fine. But we notice when the dollar starts to get cheap is when the acceleration occurs. The dollar's cheap here, we get a pretty decent acceleration. The dollar is cheap here, and obviously it's just off to the races. So in other words, the weak dollar, it kind of just, it provides a perfect storm for speculation. It lures in overseas money. It generally, when the dollar's weaker, is when we're seeing a lot of government stimulus. So there's a lot of cash sloshing around in the economy, those sorts of things. So my question is, what happens if the dollar does actually find a way to bottom? This is crude oil. So if you're a commodity speculator, you can ask yourself the same questions. Can commodities continue to go higher if the dollar finds a bottom? And the answer to that is probably no. It would be very rare to see the dollar rally and commodities rally in lockstep. Usually they're inversely correlated, and we can see that here in this chart. It's crude oil could certainly go up with the dollar weakening and or strengthening and vice versa. But when the dollar really starts to become under pressure is when speculation runs rampant. If you look at a dollar chart over the last several months, which I did not include. I should have. I apologize. But if you look at a weekly or monthly chart of the dollar, you'll notice that dollar bottoms and tops are not events. They don't happen in one day or even 1 week. It's something that happens over a couple of months. So even though the dollar has been trolling around down here near the lows for a few months, I'm not considering that a signal to count it out. I do believe that we could very easily find a low in the dollar and move higher, and that would put pressure on both stocks and commodities. Again, I'm not a doomsayer. I'm not saying we're going to crash. I'm just saying some of the froth will probably be taken out of the market if the dollar strengthens, and I do believe it will. So assuming that the stock market doesn't go up forever, there's probably a good argument for a portfolio hedge. I'm going to show you a couple ways to do that using futures and options. So just to make sure we understand what hedging is the practice of taking an offsetting position in a related asset or security to reduce the risk of adverse price movement. So if you're holding a stock portfolio and you want to continue holding that portfolio because you want to receive dividends, you don't want to incur a taxable event, and you still think in the long run stocks will probably go up, you could hold your portfolio but hedge it to reduce some of the price risk. And so that's obviously the idea. Believe it or not, the futures markets were created for the purpose of hedging. I know very few actually use it for that purpose. Most people are speculating, but it was created for hedging. So keep yourself open to that idea. Hedging is basically like buying insurance or insuring your portfolio. And of course, insurance isn't free. So what is a perfect hedge? In my opinion, a perfect hedge doesn't exist in reality. It's something that exists on paper or in concept, but in reality, it does not. And that's only because markets are not perfectly efficient. Assets are rarely perfectly priced to conduct such a hedge. For example, futures contracts only come in a couple of sizes. Your portfolio can be anywhere in between those sizes, and there's not a whole lot you could do about it other than you can pinpoint your hedge with micros, but and also, of course, there's transaction costs, slippage, so on and so forth. If there was such a thing as a perfect hedge, it would be selling a futures contract with the same nominal value as the assets being held. So for example, if you owned $190,000 worth of stock and you sold one E-mini S&P futures contract with the S&P at 3,800, that's roughly $190,000 worth of stock. That would be, in theory, about as perfect of a hedge as you can get. And when you're perfectly hedged like that, again, you're long $190,000 worth of S&P 500 stock, you're short one E-mini S&P futures, also equivalent to 190,000. In that situation, your stock account will lose value if the stock market goes down, but your futures account will gain value in the same amount or close to the same amount as the stock market goes down, and vice versa. So you've locked in your price risk, you've basically eliminated your price risk, but you still get to keep dividends, right? Your portfolio is still generating dividends. So even though you really don't have any price risk, you're still getting your dividends. So there's some benefit of holding the position in with a hedge. Of course, it's impossible to get it perfect, but if you can get something close to perfect, that's basically in a nutshell what's going on. You've eliminated your price risk, but you still keep the dividends, and you do that by selling a futures contract against your stock portfolio. It would be very rare that you would actually want a perfect hedge in place, and that's because stocks tend to go up over time. Thus, you really shouldn't be willing to pay the opportunity cost of foregoing all of your upside profit potential. If you have a perfect hedge on, you have no upside profit potential because as the market goes up, your stock portfolio is making money, but your futures position is losing. Over the last 100 years or so, the stock market has found a way to go up. So you don't always want to be perfectly hedged for sure. And most of the time, you don't want to really be aggressively hedged. My advice is it's a good time to hedge your portfolio when the stock market's high, but if the stock market's in a trough, you really probably don't want to have much of a hedge on at all. So to achieve a partial hedge, you could sell fewer futures contracts relative to your portfolio size. So for example, if you had $300,000 worth of S&P stock, you could sell one futures contract against it. And that way you've got it, basically you're hedging about 2/3 of your portfolio. That would be probably a more reasonable way to go about it, because again, stocks generally go up over time. Another thing you could do is use options instead of futures. You could buy puts, you could sell calls, or you could do both, which I believe is probably the best solution. Probably the most common form of portfolio hedging is buying puts as insurance. But I mean, just like all of us experience in life, buying insurance is extremely expensive. We pay for our car insurance and our house insurance and our life insurance for years and years and years until maybe they might eventually pay off a small amount of money. So insurance is more for mindset than it is actual financial benefit. The strategy of just buying puts, in my opinion, is highly flawed, and it's because puts are really expensive. Options are priced to lose, and especially put options in the stock market. Also, if you do buy puts to hedge your portfolio, it's only going to do you any good if you actually at some point take a profit. If you never take a profit on it, you're just spending money aimlessly for no benefit whatsoever. You might sleep a little better at night knowing those puts are in place, but financially, it's probably going to just be a big drain on your account. So this is just an example of how inefficient buying puts outright can be. These options were priced a few weeks ago with the S&P trading at about 38.50. If you wanted to buy a put at 35.50, that's 300 points out of the money. With 50 days to expiration, it would have cost 45 points or 22.50. That protection does not actually pay off unless the market drops below 35.05. So we're talking roughly 350 points lower is where you would actually break even on that insurance. So as you can see, that's a pretty expensive insurance for not a lot of protection unless the market just completely crashes. You could buy a cheaper out of the money put. A 3,300 put would cost about 21 points or about $1,000. But this only pays off if the S&P is actually the slide, I apologize, it should have been updated, but that trade would break even at somewhere around 32.80. So if the S&P is below 32.80, your insurance pays off. Remember, the reason I'm subtracting the point value of what we're paying from the strike price is because you have to make up what you paid for the option before it actually pays off for you. So what I'm trying to point out here is the cost to insure $190,000 worth of stock on a decline of 300 points or more is roughly 1%. So if you did this throughout the entire year, you might be spending 4% annually. And if you got a little more aggressive with it and made sure you have protection on constantly, you might be spending even more than that, maybe 6-7% of your portfolio just to insure it. Now, let's see, we get corrections roughly once a year on average, and those corrections are 10 to 13%. Sometimes they're bigger corrections, but that only occurs maybe once every 3 or 4 years. So with that in mind, it really doesn't make a lot of sense to spend 4 to 6% every year on hedges. Also, although we've had some really big runs in the last couple of years, the long-term average in the S&P is about 10%. So just imagine if we are making 10% every year on average, and we're spending 5% of that to hedge our portfolio. It makes no sense at all. There's a better way. I'll show you a better way in a minute, but let me just illustrate this one more time. So this is how a long hedge would work. If you are long roughly $90,000 worth of S&P stock, and you think the market's a little frothy, you could purchase a put option. Okay, sorry about that. So if you buy the 3,600 put, your protection kicks in right here. Sorry, it's a 3,700 put. I think down here. Sorry, I apologize. So this is buying the 3,700 put with the S&P trading somewhere around 38.60, 38.50. So this is only going to protect you if the S&P drops below the last low and has a decent sized sell-off. But most of the time you're going to spend that money and it's just going to go up in smoke like most options do. Again, options are priced to lose. And this is $1,800. That's not chump change. It can add up pretty quickly. I mean, imagine buying puts all the way from the March low through here. You might have benefited here, maybe here, I doubt it, but most of the time you're just going to lose 2 to 3 grand all the way up. I'll show you a better way. Now, of course, there's no perfect way to hedge because by definition, when you hedge, you're reducing or eliminating price risk, which means you have to give up something, okay? Because it's not free. Insurance or protection or peace of mind is not free. Here's what a short futures hedge might look like on paper. Again, this is not the best way to do it. I'm just showing you how it might work. But if the S&P future was trading at 3,900 and you sold a futures contract and you were, let's say you were hedging roughly $190,000 to $200,000 worth of stock, your futures would protect you tick for tick below, but tick for tick above, you're giving up all of your portfolio gains. So if the market goes up, your stock portfolio makes money, but your futures hedges loses, and vice versa on the way down. You're locking in your price, but you're still keeping the dividends and interest and those sorts of things. So you have no price risk. You can sleep well at night, but you're also giving up any upside potential. And we've all said this many times before. I'll say it one more time. Stocks generally go up in the long run. So you don't want to always give up your profit potential. Now, in a market like this, where I think it could be argued like in some of the slides we showed before, that it's extremely expensive, that might actually not be a horrible idea. If you give up your profit potential on the upside, you're probably not giving up that much. You might be giving up 3, 4, 5%, but the risk of a big correction, 10% or more, is we're overdue. So I'm not going to say it's likely, but it's definitely a reasonable proposition. So a futures hedge in this environment might not be such a bad idea, but I still think there's a better way. So the better way is using risk reversals. And again, this is my opinion. Other people might have different opinions, but let me talk to you about what a risk reversal is. It's basically free insurance, kind of free. Free when it comes to money, but there are opportunity costs. So the idea of a risk reversal is you purchase puts, but instead of just paying for those puts out of your portfolio, you sell a call to pay for those puts. So you're allowing the market to finance your insurance, is in a nutshell what you're doing. You get the result of put insurance without any out-of-pocket expense. The opportunity cost is forfeiting any stock gains above the strike price of your short calls. So the opportunity cost is you're capping your profit potential on the stock portfolio, but there's also something else to keep in mind. There's a margin cost. So if you're hedging your stock portfolio with futures and options on futures, we're dealing with two accounts here. You have a stock account and you have a futures account. Even if you're trading at a brokerage that offers both, those two accounts are separate. They're margined separately. For risk purposes, they're treated separately. So you must have enough money in your margin account or in your futures account to execute the hedge. Now that hedge, depending on how aggressive you want to get with your hedge, how much time is on it, so on and so forth, could be anywhere from 5,000 to 12,000. I would say if you want to hedge your portfolio with one S&P option spread, you'd probably want about 20,000 in the account, just to make sure that you're not going to have to worry about margin calls and you don't get forced out of your hedge prematurely and so on and so forth. Because your futures broker isn't going to care that you have $200,000 worth of S&P stock making money in a different account. If you're losing money in your futures account, you no longer have the margin to hold that hedge. So you have to be prepared to write out the ebb and flow. You have to be prepared to put some money inside just simply to execute that hedge. But I think you'll find it might be worthwhile. So here's what a risk reversal might look like on a chart. S&P again is trading somewhere in the mid 3,800s on this chart in this example. If we believe that the correction could be imminent and we want protection below the last low of 3,700, we could purchase a 3,700 put. But instead of paying full price for that, like we did in the last example, which was a couple $1,000s, we could sell a 4,000 call to pay for that. In fact, in this situation, we would be selling the 4,000 call for a little more than what we are paying for the put. We're selling it for 42 points. We're buying the March 3,700 put for 37 points. The net result is a credit of $250. So the market is paying us a couple $100 after commissions and fees to hedge our portfolio. The only risk to you is assuming that you have the underlying stock. Now, I want to make this very clear. If you put this position on and you don't have 190,000 worth of S&P stock somewhere else, that's not a hedge, that's a speculation, and that's fine. This can be a good strategy for speculating, but it only works as a hedge if you're actually truly hedging that asset. Otherwise, it's just added risk. But anyway, with that said, the only thing that you're giving up is profits above 4,000. With the market at 3,850, that's 150 points higher. I think that's a pretty fair bet. What is that? 2.5%, somewhere in there? I'm told, I could be off. I'm just going off my head. But on an annualized basis, if the S&P goes up 10%, if you are willing to give up any gains above 2.5% in the next 4 or 5 weeks, I think that's a pretty good trade-off. I think that's reasonable. Most of the time, the S&P won't travel that far that fast. Of course, in this market, things are a little different. This is a very quick moving market, but in the overall scheme of things, giving up anything above 2.5% for free insurance in case we do get a big correction is pretty attractive. At least it is in my opinion. So in other words, the idea is if you sell a call to pay for your insurance, you're giving yourself cost-free insurance. Instead of, I'm not going to use the word free, I'll just use the word cost-free. Another thing I want to keep, I'm sorry, it's been a long day. Another thing I want to point out is timing does matter. Some people, for whatever the reason, they feel like if they're hedging, then timing doesn't matter because they're hedging after all. But that actually could not be further from the truth. It's very naive to believe timing is irrelevant when hedging. I will admit it's more relevant when you're speculating, but when you're hedging, it's almost as relevant. If possible, hedges should be put on when most people think that they aren't needed. For example, as the S&P is moving higher, if we get back to a situation where we're making new all-time highs, very few people at that point are thinking about hedging their portfolio, but that's exactly when they probably should be thinking about it. Similarly, hedges should be offset or reduced as the market moves lower. If you never exit your hedge, there's no point of doing it. This is precisely what I'm talking about. This is a situation, I mean, these are hypothetical. This isn't an actual position that I was following, but I charted it out after the fact. The black is the June S&P last year, and this is the 2020 coronavirus sell-off, which took us all the way down here to 2,200. The red is the 2600 put for June. You can see that, let's assume that a trader was savvy enough to put a hedge on here right at the market high. Again, this is hypothetical, but it's to prove a point. A trader that would have purchased a 2600 put for June in February, this looked like roughly the end of February, beginning of March, would have paid $10 in premium, or roughly $500. That option at one point would have become worth $24,000. However, if that trader never sold the option, if he wrote it all the way up and never sold and then wrote it all the way down, he would have actually lost money. So this just goes to show you, you're not doing yourself any good, even if you hedge perfectly, but you never take a profit on your hedge, you're doing yourself more harm than good. Because I mean, you're only out $500, but $500 is $500. When you could have, even if you would have sold early, let's say that you bought it for $10 and you sold it for $100, even that would have been pretty spectacular hedge. It would have been pretty depressing to see it jump all the way up to 24,000 when you just sold it for 10,000 or 5,000 or whatever the case is. But the point is, something is better than nothing. If you buy a hedge and you write it all the way out to zero, there was no point. Although that said, I do think it would have taken a lot of the emotional turmoil out of things up here. But that's the one caveat with hedging, is you have to get out to make it worthwhile, but you also have to understand that you're never going to get out at the exact perfect time. So you just have to be happy with whatever you get and hope that you can psychologically manage. So again, when hedging, timing is everything. When the ES is moving higher, calls are generally overpriced and puts are underpriced, which is what makes this type of hedging so attractive. If the market's on an upswing, you're selling the call options at top dollar, because that's, everybody wants to buy calls when the market's going up, just like we're seeing now. And you're buying the puts on the cheap, right? You're buying them from the discount rack because the market's on the way up. So that makes this hedge even more spectacular when it works. And if your timing is good and you pick, we all know it's almost impossible to pick a high in a market, but if your timing's pretty good and you do it at an upswing and you pick somewhat close to a possible turning point, the results are better insurance. You have a higher cap on your profit potential. In other words, you're selling a call with a higher strike price. You have a higher level in which the downside protection kicks in because you're buying puts when they're cheap at a higher, hopefully at a higher strike price for less premium. And you're less likely to incur margin issues in your futures account. You should always hedge when you can, not when you need to. Don't wait until the house is on fire to buy insurance. So another thing I want to mention is you don't want to do this type of hedge in a big downturn. So for example, March of last year, when the market was around 2,200, you absolutely do not want to do a risk reversal hedge. You don't want to sell a call and buy a put, because you're doing the opposite of what you should be doing, right? You're selling a call when they're incredibly cheap and you're buying a put when they're incredibly expensive. You want to be doing the opposite. Okay, so hopefully you picked up something from today's lesson. Hopefully it wasn't too scattered. We had a lot of information we were trying to convey in a short amount of time. If you're interested in trading futures and options, we'd love to have you. We'd love to talk to you. You can reach us at DeCarleyTrading.com. And if you're a reader, TradingCommodityOptions.com has a lot of information on our latest book, which is Trading Commodity Options with Creativity. There are excerpts, sample chapters, charts, those sorts of things. And again, don't pay attention to all the other stuff that's on Amazon, focus on the 3 newest books. This is the newest, Trading Commodity Options. And if there's anything I can do for you, or you have any questions, here's my contact information.